Do you remain optimistic? Do you think the overall, and I know you invest, you're a stock picker, but do you think the macro market will end this year higher than it is right now?
Absolutely.
Why?
Absolutely. I think because the market, look, Q4 was one of the worst 7 quarters since 1929. You were pricing in a recession. There's just no question about that. We're not getting one. I mean, at least there's no indication.
What makes you so confident to say that?
Because there's no indication in the data, right? When we take other people's money, it's our job to try to look at the data and make the best informed decisions. So if you look at the indicators of recession, you have a pickup in claims that occurs beforehand. You have inflation picks up, housing starts roll over, spreads blow out, the yield curve inverts, ISM manufacturing goes below 50. None of those indicators are anywhere near recessionary levels. So if that's not the case, you're dealing with a non-recessionary pullback. There have been 12 since 1930, average of 25% down over 6 months. 12 months later, you're 32% higher on average.
Okay.
And so we think we're in that latter case, not the former.
Okay, and all that, I hear you, but does that mean that stocks are a good value? Because the stock market and the economy are sometimes the same thing, but not always the same thing, Steve.
Yeah, but bull markets end in recessions. They don't just end because. They don't just get tired and stop. And so if you don't have a recession, there's no reason to think that the bull market is over. Also, when you look at where the market's pricing right now, we traded as high as 18.5 times last year. We're nowhere near that. And we were down at 14.5 at the bottom. So on a reasonable valuation, with earnings growing around 5%, you get to new highs. It doesn't take, it doesn't.
What looks then particularly solid from a value perspective to Federated and you right now?
Oh, it's absolutely the cyclical parts of the market.
What does that mean?
So energy, industrials, materials, tech, parts of discretionary. These were all down 30% between, or close to 30% between the top in September and then that Christmas Eve low. And you've started to see some rebound there. Small caps, defensives are also very attractive, and some of the dividend parts of the market, which is to say quite a bit at this point.
So are you buying more dividend-heavy stocks?
Within the global allocation fund, we generally tend to buy more broad parts of the market rather than individual pieces. But as we recommend to our investors at a firm level, we very much like large cap value, which is going to include a lot of those.
Yeah, large cap value. Is that where, I mean, small caps did so well for a couple of years here. Yeah. Technology, you ever heard of the FANG stocks? Yeah. The FANG stocks did so well. Are you saying we just kind of need to get back to basics in some ways?
Well, look at the small caps as an example. They underperformed large caps by about 7% last year. And the reason why is because rates were rising, and 50% of their debt is variable rate. So they're going to underperform. Well, since you've seen the 10-year go from 3.25 back down to 2.75, you've seen these things kind of really outperform to start the year off. And I think what you're doing is you're repricing stocks for a different world. We're not hiking rates once a quarter between now and the end of time.